Lovely. Perfect. Everything's good to go. Now, welcome, ladies and gentlemen. We have a very interesting webinar today. I'm very happy to have our Masterclass webinar done. We're integrating lending, investment, and advisory services today. We're talking about a modern approach to growth, risk preservation, and a strategic partnerships between a few companies. Now, I'm lucky enough to be joined by some serious professionals in their industry, starting off with Abraham Aguilan, Managing Director and Wealth Manager for Affluence 360, as well as Megan Bourke, Director and Lending Specialist for Hummingbird Financial Services, and obviously myself as the host today a little bit, but also the Trading Floor Manager, Lachlan Callaghan from Sharewise. So I think just to begin with, before we talk about today's discussion, with regards to yourself, Abraham, what is Affluence 360 and how has it come about?
No, excellent. Thanks, Lachlan, for the introductions. So Affluence 360, we're really all about what we call 360 advisory. That's making sure we understand the client, we understand what your goals and objectives are. And then we put together a roadmap, an advisory roadmap that allows you to really understand what your options are, what are the pros and cons, as well as getting you the direction to the outcomes that you're looking to achieve. Real simply, our mission is to enable your aspirations and help you achieve your goals. And we do that through our strategic partners as well. So we've got an in-house team, but we also have our strategic partners, just like Sharewise for the investment management and stockbroking side, and Megan Bourke as a lending specialist that helps support our team and our clients.
Beautiful, beautiful. And for yourself, Megan, obviously mortgage broking and lending specialist is a very competitive area. How did you get started and how you've been helping our clients?
Thank you, Lachlan. So I suppose like many businesses, I'd had some fairly ordinary experiences with brokers myself, and that was kind of what led me to think about doing it differently. I wanted to start something that offered a higher level of service and care. It was really that simple. And similar to what Abraham just mentioned, I like to work with people across various different facets. So it's not a transactional, you come to me, you get a loan, you go away. We look at what's happening for you now, what's happening for you in the future, and then we revisit as often as possible to make sure that you're getting the best out of the setup.
Brilliant, perfect. Well, today we'll be discussing real-world examples of aligning lending through investment and advisory expertise. We're going to be talking about how Affluence 360, Hummingbird Financial Services, and Sharewise align ourselves together, and more importantly, how a potential client could utilize all the services. So with that, what we'll do is we'll get through a presentation. We'll have a chance for clients to submit some questions at the end. There is a submission questions in the bottom right of your screen. If you want to submit those, we'll try and read them out at the end. But so with that, we'll lead on the way with Abraham. We'll start to share the screen and I'll hand it over for today's first session.
Excellent. Thanks for that, Lachlan. Sorry, just trying to get through the slides. So Lachlan, next slide, please. All right. Quick general disclaimer, everyone. Obviously, what you're seeing today does contain some numbers, but it doesn't take into consideration anyone's individual personal objectives, financial situation, or needs. So it's all just general information that we're presenting today. Thanks, Lachlan. So again, a little recap about what we do at Affluence 360. We offer 360-degree advisory services where we give holistic financial solutions, integrating wealth management, tax planning, property, and lending to achieve comprehensive long-term client success. Next slide. So a little bit about this strategy and what we're looking at today. We're talking about home equity gearing. So in this scenario, we've got a property and a couple who have a property at $2 million and they currently have a home loan against that property of $900,000. Now, if you look at the top right there, you can see that $900,000 against their owner-occupied home obviously means it's a non-deductible debt. What they are looking to do is they've got a fair amount of equity against that property. And they're obviously looking at, I guess, extracting some of that equity and using it for investment purposes. Now, doing this, they can pull out up to 70% LVR, that's a loan to value ratio. So by doing that, they can take a further $500,000 out of the equity of their home. Megan will talk through the structuring and how that all kind of works. Once they've taken that out, if they were to invest those proceeds into an investment portfolio that produces income, the interest against that home, that portion of that investment loan now becomes tax deductible to you as well. So that's what we call a home equity gearing strategy. Next slide, Lachlan. So again, in that scenario, we've got client one and client two. They're a couple earning joint income of $440,000 per annum. Let's call it 220K each. Existing primary residence is valued at $2 million. Existing mortgage is at $900,000 with an interest rate of 5.39. And let's say they've got a 20-year loan term. Combined net after-tax income is just over $300,000. And in the current situation, the total principal and interest repayments are $73,622 per annum. So again, in this scenario, we're looking at drawing $500,000 of equity out of that home loan, assuming we can get that with a 5-year interest-only loan term at an interest rate of 5.69% at a 5-year term. After that point, it changes to a principal and interest repayments and a slightly reduced interest rate. We've then looked at the investment portfolio returns as well that Sharewise have been able to generate averaged over the last few years. And so that's a 20.76% return with an income yield of 4.76. Franking credits on the stocks are 54% and the growth rate of 13.4. We've assumed that the income dividends remain in cash with an interest rate of 2% per annum invested annually. The property growth rate at 4%. And for the first 5 years, your interest repayments obviously will increase to 122. And once the P&I on that interest loan, on the interest component of that investment loan, after 5 years will also increase. But we'll go through some of the numbers together here. Thanks, Lachlan. All right, again, in terms of some cash flow disclaimers, obviously we don't make any assumptions on capital gains tax or the buying and selling cycles. And please note that this may not include financial advisor and brokerage costs as well. Okay, so as you can see in the first year, there is going to be a slight increase to cash flow, right? And that's because we've taken out the home loan, an additional $500,000 in that home loan. So until investment income is produced by the investment portfolio, there is a little bit of out-of-pocket cost that needs to be taken into account. But by year 2, you can now start to see that your net cash flow position actually increases, and that's even after taking into account all of the repayments. By year 5, you can see there is a dip in net cash flow again, but a lot of that, it has to do with the interest only term on the investment loan ending. And again, as part of our ongoing review process, together with Hummingbird Financial, is just part of the strategy, and we can adjust things as we move forward. Thanks, Lachlan. Perfect. This next slide actually shows the tax savings by each individual as a result of running this strategy. Now, you can see currently together, they're paying about $69,500 in tax. And by implementing this strategy, because of the tax savings available to them from the interest deductions, they are saving tax cumulatively over the 10-year term, about $43,000 in total tax savings as well. Excellent. This shows the gross asset position. Obviously, at the starting point, you're going to have a little bit a higher asset position than you are because we've bought a new portfolio. But the next one, we'll go to a slide that shows the net asset position, which clearly shows the outcomes as well. Excellent. This scenario shows that you've got deductible debt that we've now created as a result of the strategy. It also shows how your principal debt as well kind of stays the same and as if you were paying it down. But when you start thinking about all of the tax savings as well as the income that the portfolio is generating, there is the opportunity now to use that and pay off your non-deductible portion of your home loan a lot faster as well. Thanks, Doctor. So this shows now what the net asset position could look like after 10 years. Obviously, taking into account the portfolio returns, as well as the value of the property. So that would be the current position. If it's just the value of the property that's growing, obviously it grows quite substantially over 10 years. You'll have a net asset position of 2.35 after the home loan. In this scenario where you've got a portfolio running alongside that, could be anywhere up to 3.895 million, assuming the returns may remain consistent over that period of time. And one thing we want to do as part of our regular reviews is also consider debt recycling. So as you can see in this scenario, after 5 years, the value of the property has now increased to 2.4 million. Your deductible home loan is still at 500,000 because we kept it at interest only, and it's now about to turn into a principal P&I interest component now. And you've got your non-deductible home loan, which you've paid down a fair bit from 900 down to 750. What we could do at this point in time is potentially look at drawing out of the share portfolio about $150,000, repaying the non-deductible portion of your home loan. That takes that now down to 600, but potentially then redrawing the 150 back out again against the investment loan. So you've now increased your deductible debt component and reduce your non-deductible debt component. And over time, we could be recycling this where at the end of it, you've got zero non-deductible debt and a portfolio that's producing income to support that deductible debt component or investment loan component. So the key benefits really is potential for higher returns. You've got some tax advantages and wealth acceleration and the diversification opportunity. Now, in terms of key risks, it's always important to consider insurance, making sure that you've got insurance to cover the additional debt you're taking on. Obviously, gearing means that you could be magnifying losses as well as magnifying returns. We want to make sure you're looking at what your cash flow requirements looks like. We'll sit down with you, make sure we understand that there is no strain, or if there is, what's our exit strategy and what's our plan around it. Interest rate risk is also a big one. But what we're seeing now, hopefully rates are coming on the way back down, and market volatility. A lot of the returns that you've seen has assumed linear returns. That never is the case, but it's about long-term investing and having a real strategy and a team behind you to support you along the way. So that's pretty much it for me. So I might hand over now to Megan to actually go through the lending side of this strategy and how we can work together.
Thanks very much, Abraham. So Lachlan, I might get you to move you up just onto my disclaimer as well. And whilst the disclaimer is up, I'll just introduce myself. So thank you for joining us today. As we mentioned, my name's Megan. I'm the Director of Hummingbird Financial Services, and we're a boutique finance brokerage located in Sydney. We specialise in residential and SMSF lending, along with selected commercial transactions. Look, we do a lot of work with investors to release equity in order to invest, but typically they're using this to buy more property. And we see a real opportunity for people to use this same method to invest in other asset classes. And I'm here to run you through that today from a lending perspective, but also to help explain how we collaborate with your other advisors to make sure that any lending that we organise for you aligns with your overall goals and needs. Can I have the next slide, please, Lachlan? So first of all, I thought I'd go over what types of loans we're talking about, because we're not looking at margin lending, private credit, or even commercial finance. What we're reviewing today are what you might consider to be just regular loans secured via a first mortgage over a residential property. So the loans are coded under the NCCP or the National Consumer Credit Protection Act, and they're priced far more competitively than some of the other non-coded options that I just mentioned. Today's example uses a principal place of residence, but an investment property can also be a suitable security as long as it's a residential property. Next slide, please. So ultimately, there are two things that we're looking for to make this type of lending work. There's equity and serviceability. So as Abraham mentioned, equity refers to how much of the property you own. Now, this could be obtained through repaying the original loan or growth in value, or typically it's a combination of both. Today's example shows a property worth $2 million with a mortgage of $900,000. So that leaves equity of $1.1 million and a current loan value ratio of 45%. Now, the loan value ratio refers to the value of the mortgage proportionate to the value of the property. And this is a really important number, not only for, is it a risk consideration for your advice team, but banks also have different rules and policies around this number. Serviceability refers to the borrower's ability to meet the repayments, and that's determined by a number of factors, including income, expenses, and existing commitments. We also need to consider interest rates as they are today, with a buffer being allowed for if they increase. Now, the income types that can be considered are salaries, self-employed income, rental income, so from existing and new investment properties, trust income, and depending on the lender, superannuation pensions and certain types of investment income can also be included. Next slide, please. So from a practical perspective, if you'd like to look into whether this option is suitable for you, we can arrange a call just to go over some top line numbers and give us an idea of what's possible. From there, you'll work with Abraham and his team to refine your strategy, and he and I will collaborate on how to structure everything. As part of this process, we often workshop a couple of different sort of lending options just to make sure that we really do have the right one for you. And one of the crucial steps in this is ordering a valuation fairly early in the piece, because that will help us work out that all-important loan value ratio. Once everything's aligned, it's just like a regular loan. We're not talking about second mortgages or anything like that here. So depending on which lender you're with, it might be a second loan under your existing mortgage, or it may be a case of refinancing the existing loan and adding a new one. So whilst everything's done under one actual mortgage, we keep the loans themselves separate. This is done for reporting and taxation purposes, and it also allows us to set up different repayment types. Typically, you would want principal and interest repayments against your home, but the interest-only option against your investment. From a time perspective, it depends on the lender, but once we have all of your required documents and we're ready to submit the application, we'll receive a formal approval between some lenders will do it in a day, others take 5 to 7 business days. And then once we have the formal approval, it's around 10 business days until settlement, just depending on the existing arrangements you have. During this time, I'll be liaising with Lachlan so that he knows what to expect and can have his plans ready as soon as you settle, so that we can get that money invested and working for you as quickly as possible. Next slide, please. Beyond the settlement, I'll check in with you straight away to ensure that the setup is as it's supposed to be and that you're happy with everything, and you can contact me at any time with any questions regarding the loan. Then between Abraham and myself, we'll review your lending at least annually to ensure that the loan is still the best option for you, and also to explore further opportunities for you to grow your investments. So that's it from me for now. It was a very general overview, so please don't hesitate to contact me if you have specific questions or if you'd like to discuss your options. In the meantime, I will hand you over to Lachlan.
Thank you so much, Megan. I think this is already showing a lot of how a client's process from start to finish would happen. And basically we come to almost like an end result of the performance, what it comes down to. And for Sharewise, a lot of what we hear from clients is we read the headlines, there's a lot of market volatility, stocks are up one day and down the next. And the big thing with us at Sharewise is we don't like to risk. And because of that, at Sharewise, we do have the vision to perform. So we're a full service share advisory. We're based here in North Sydney, just at Nelson's Point. We provide buy and sell advice on the ASX, but also on international stocks. We combine institutional grade research with technical analysis, which doesn't just find us undervalued, great dividend paying stocks, but also engages the time to be in those, and also the time to reduce our risk if things are getting a bit choppy. So this is our general disclaimer as well. With the scenario that we're talking about today, past performance isn't a reliable indicator of future performance. And so we've just got to take that into account of the scenarios that we're talking about. So the real issue that we always see with being on the sidelines, either not in equities and getting dividends at least, is you're standing still. Your inflation is eroding away the potential returns that you could be getting, and interest rates, as we've known right now, are coming down. So keeping cash in a bank may feel safe, but as we just said, inflation is quietly eroding your savings every single month. In other words, your money is losing value while it sits still. Meanwhile, interest rates cuts are creeping in, and banks, financial services are facing tighter margins, as well as insurance companies are seeing reduced returns. That means these dividends that they traditionally did pay are also being reduced. So where's the insight to make sure that your dividends are staying secured so you're getting those sort of returns? Now, keep in mind, a lot of dividend investors are looking in the Australian market, and we're very much open to that. We'll be talking about a little bit of our ASX dividend portfolio, but we're not opposed to being diverse and allocating internationally, because being concentrated in one area does increase your risk. And there's other stocks out there that do pay dividends, maybe not as high dividend yield, but do pay a constant dividend that we can take advantage of. Now, our return for the last 5 years per annum has been roughly around about 13.4% on our ASX dividend portfolio, in comparison to the market's return of about 10.21. Now, that means we're outperforming the market by 3.1%. The big thing that I don't think that highlights enough is the amount of risk that we're taking on that, in the sense that because of the market volatility that's been occurring, there was periods of time where ultimately we were sitting in more cash drives vehicles, more so than being directly allocated to the market. We're able to pick up stocks at a cheap valuation to increase growth for the future and secure that dividend for the future as well. This all means that basically sitting on the sideline waiting for everything is delaying your financial freedom. And we want to be helping you at this point in time. So when it comes to our strategy, we're focused on very high quality Australian equities, especially on this ASX dividend portfolio. As you'll see, there's a number of positions. We've got about 37 in that portfolio, with an average market capitalisation of 61.7 billion. We are looking at across a few sectors: financial, material, real estate, with also defensive exposures to consumer staples, as you should, and infrastructure, to ensure that income stability. The big thing comes down to, well, anyone could do that. Why work with the Sharewise? Why get a manager to manage this? And it comes down to our timing. When the stocks become too overvalued, or we see that they're going to digress in their dividend payments, it's possibly a good opportunity to start de-investing out of those positions to allocate to others, to make sure that those dividends are secured for your future. To make sure, well, with this strategy as well, and to work, and that's the key thing. So it's designed for investors who want reliable income along with measured capital growth, by providing that blend of proven blue chip holdings, as well as some targeted mid-cap opportunities that we depend on yield, but also a bit of growth without risking too much in the portfolio. The results do speak for themselves. As I said before, our approach has delivered 13.4% compared to the market of 10.2%. Now, a lot of people ask me in that sort of regard, well, how do we do it? For us, it's about timed executions, not just buying for the sake of buying, but buying the stock at the right time, diversifying the portfolio gradually into the market. If we just lump it in, then there's a potential of earnings season. There's risk of a dividend already being paid. That opportunity cost being in that stock already is too high for us. The defined parameters that we are methodical in that. The big thing that I want to highlight is the real reason that we outperform is how we measure our risk. We don't want to be losing more than 2% on a position. If we're losing more than 2% on the entire position, we start to really deep dive into our research to see why is that the case. And because we're focusing on that, it's our non-negotiable. Our risk management is non-negotiable because at the end of the day, we do not want to be losing capital. We do not want to be digressing in our dividend yield because when we're underperforming the market. And here at Sharewise, we do not want to be underperforming the market. So we apply rational risk analysis with the one goal to protect our clients' capital. But how do we work? The way that we work is through general advice. We're non-discretionary. That means that we never buy or sell without permission, and clients always have complete clarity on what sort of stocks we're invested in at all points. Meaning that hypothetically, Abraham, if he in the scenario came back and said, "Look, in 5 years' time, things have been doing extremely well. We want to take that 150,000 out of the share portfolio to pay down our mortgage a bit more." We're willing. We're open to that scenario. And I imagine that Abraham, as you said before, that this is the sort of strategy they would want to put through as well, correct?
Yep, absolutely. And over the long term as well, it's about recycling, rerunning that strategy, and really, maximizing the outcome on an ongoing and regular basis.
Absolutely, absolutely. So we do cater also for other growth portfolios. We're not just focused on dividend portfolios, but this is a conversation which we would have between the lead advisor, the lead wealth manager, as well as with the client. Because this would in turn enact a bit more risk and possibly wouldn't be for the strategy for everyone. But at the end of the day, at Sharewise, our main thing is we want to take away the stress and uncertainty. We want to reduce the frustration of poor returns and the lack of unprofessional guidance. Our clients are professionals, business owners, active investors, and retirees. They trust us because we build their wealth, preserve it, and simply look for a smarter way to invest in the share market. In short, we want to deliver that expert management, reliable performance, and peace of mind. So you can focus on living while we focus on your portfolio. And I think the big thing before we get into questions is, and I'll open this to the floor, Megan, we had a meeting yesterday, and Megan had a very good comment that I wanted to bring up, and it was every decision that each one of us financial advisors make is in the best consideration, best angle for the client. Because at the end of the day, if our client is performing and doing really well, then they're going to be working with all three of us for a very, very long time, and the strategy will succeed. So I think with regards to that, I might pass over to Abraham in the sense of just an overview of maybe a bit more of the risks that we can talk about. But if you do have any questions, please put them into the questions tab, and we might go through with that. So Abraham, when it does come down to risk, I know you touched on it a little bit, but where do you see majority of people go wrong? Is it the structure of how they set it up initially? Is it they don't have a goal that they set properly for themselves? How do you see the plan fall apart?
Yeah, no, great question, Lachlan. I think it really starts there is why are they doing it, right? As I say, why are we doing this? Usually clients will come up to us. The biggest problem that a lot of people have is tax. The biggest expense really. And so they'll come up to us with this. We've got a good position financially. We know we want to move forward, but we're kind of just spinning our wheels, if that makes sense. And so what we can kind of do is come back, take all of that noise away, put the numbers in front of them and show them here's a strategy that could work really well for you based on your circumstances and based on your goals. And then it's about overlaying that, I guess, with a risk management strategy, right? Understanding, again, if we are to take on an extra $500,000 of debt, what does this actually mean for you? and really going back and looking at from a cash flow perspective. Personal cash flow is a big one. We're not here to tell you what to spend or how to live your lifestyle. But what we should be doing is making sure this is complementary, and that if there isn't, like I said, an out-of-pocket expense there for you, is can you actually afford it as well? There are other compromises that we need to make in terms of lifestyle to do this. But at the end of the day, if you've got that goal, I guess when you say risk, the biggest risk that we have here is when you're, I guess, nervous about the market, you're at the bottom, markets will move up and down. And so that's what we're here. Lachlan, myself, Megan will be the sounding board, get you through that strategy, get rid of that noise, and really keep looking forward, I guess, to, better outcomes.
Absolutely. And so for yourself, Megan, obviously we're seeing interest rates pulling back at the moment, and there's probably a lot of opportunities out there. How are you more or less deciphering what's probably best for the clients? And with those reviews, what is the common theme that you find?
One of the things that I come across really often as a broker are people who are in very sound financial positions. They've got great income, great financial habits, but they don't really know where to start with investing. And they all sort of default to property, but it's such a big investment with so many costs and risks attached. And I think people, they look into things, but then it all just gets too hard and they put it on the back burner. And like Abraham was saying, they don't really go anywhere. And I think by getting the proper advice and actually doing the numbers, you can actually see how achievable it is to enact a lot of these strategies. Now, interest rates, they did go down. I'm not sure if we'll get any more cuts this year, but ultimately, when we assess these loans, there's a buffer anyway. So we do actually allow for if interest rates increase, and then if interest rates decrease, that's just a bonus for you. So I don't worry about that too much. We're never taking people to the edge of what they can afford. It's all very much, risk mitigated, this strategy.
Okay. I've just put up on the screen the details to contact Megan. Obviously, Megan, what's the best way for people to reach out to you? Is it via your email address, website, or is it best just to give you a call?
Email or call, whatever you like. I have some clients that only like to text, so you do you, and I will work with you however you like.
Absolutely. And obviously, I'll try and get up the contact details for Abe as well. But for yourself, Abe, obviously, a lot of your clientele like to reach out, and more or less with regards to this process as well, you're probably going to be the primary contact to before any of let's say the flow goes on. What's the best way to get in touch with yourself?
Yeah, absolutely. Just jump on our website, and there's a contact us now form there, or you can always just send me an email. It's abraham@affluence360.com.au. And we've got a little QR code as well, which I believe our team have uploaded a couple of resources. If you wanted to scan that, you can jump online and come and check us out.
Perfect. Perfect. We'll supply, we'll make sure to supply emails to all the advisors here today to make sure that they can get in contact with you. We do have one question that's come through, which will ask this question for Lachlan. What is the minimum amount required for an individual to start trading with you? And can under 18s have an account with parental control? So with parental control, we do allow for that in that scenario. And for a minimum account, it all comes down to what are our goals. I'm very happy to be working with a small account. When I mean small account, probably working with under about 50,000. But the goal would be for long-term growth. We'd be very much happy to set up on that long-term basis of probably growth, most likely through Australian and international markets. But at the end of the day, it's going to be commercially viable for that individual as well. I think that's at the end of the day, if it's that sort of advice as well of where to start in the market, we're happy just to provide some research and even just have a chat about that. So I hope that answers your question. We can always have a chat a little bit later after that. But apart from that, if you wanted to contact me, I'll be sending out some information with regards to my contact details. My phone number is always open and available, and I'm always got an open door policy when it comes to the office. But I have to say thank you very much to Abraham. Thank you very much to Megan. Abraham, is there any final comments that you want to make?
No, I think it's it's been an absolute pleasure for this webinar, guys, and hopefully, I'd love to see you all at the next one.
Beautiful. Megan, yourself?
Yeah, look, thank you to everybody for your time this morning. If you're curious, just reach out. There's no obligation. It won't take a long time. You don't have to supply a lot of information or anything like that. Let's just have a quick look at it and see what's possible, and go from there. Thank you very much.
Excellent, excellent. Well, thank you so much. We'll probably wrap things up from here. And apart from that, this is being recorded, and we'll look to distribute that. If you didn't catch the whole webinar, you'll want to go through a few things. This will be uploaded. Megan will have access to this. Abraham will have access to this, and we'll also have it on our YouTube channel. So thank you all for being in attendance today. We'll look forward to speaking to you soon.